Hey, this is Dr. Gold again. We're up to the investing chapter here, and because I have a lot of experience with this, having worked on Wall Street for 12 years and managed a money management business with a business partner of mine, I feel like I'm well positioned to really share with you a couple of insights that might get you over the hump of beginning to invest money. Again, a lot of students, will come up with a long laundry list of excuses for why they cannot invest. For example, I don't have any money. It's too complicated. I don't understand it. It's too risky. Um, I'm a starving college student. How can you expect me to invest in the stock market? What small dollar amount's going to make? Is it going to really make any difference in the future if I invest like $25 a month? All of those excuses are understandable because when you're asked to invest money in the stock market, you're basically being asked to take on risk, and most people have an aversion to risk and they don't like it. But in all honesty, this is the only way for you to accumulate wealth over a long period of time. A lot of students say, well, I'm willing to take some risk, but I want to make a lot of money, in a very, very short period of time. Well, that's virtually impossible. It can happen, it does happen, but it's like playing the lottery. You can't really have a logical approach toward investing by hoping and trying to make money over the short period of time, let's say a month or 2 months or 6 months or 1 year. Everybody wants the home run, but it's very, very hard to achieve that. So a better strategy is one called dollar cost averaging, which I'm going to go over with you in one moment. But basically what it suggests is that over the long run, if you invest a consistent amount of money and you alter how you're investing that money each month by putting a certain allocation into the stock market and a certain allocation into the risk-free savings account, that you'll be able to accumulate a substantial amount of money over a long period of time. The goal, of course, is to put as little money at risk in the stock market when the stock market is at or near an all-time high, and to maximize the amount of money you're putting at risk in the stock market when it has plummeted and gone down a lot. Now, that's easier said than done because our emotions are such that when the stock market is high and it's moving up and it's in the news every day and your friends and or family members are telling you how much money they're making in the stock market, there is an increased temptation to want to sort of jump on that bandwagon and invest money at that time because it seems like it's easier to do at that time because everybody else is making money. And actually what you should do is the exact opposite. You should be investing as small amount as possible when everybody's all euphoric about the stock market. You have to kind of have an opposite approach. On the other hand, when the stock market goes down a lot, people get scared. It's usually gone down because the economy's bad, people are losing their jobs, it's a scary time economically, and people think you're crazy to invest money in the stock market, but it's actually the best time or lower risk time period to be investing. So just keep that in mind as we work through this table that's on the screen right in front of you. To begin with, you'll notice that the monthly investment amount of $25 here is consistent as you move up and down the rows. It's $25 every single month. Now, how did I come up with $25? Well, I just put that in there. But what you should do is you should think to yourself, if I were to open up my wallet or my purse and a certain dollar amount was missing from my wallet, how much money? No, first of all, nobody would be happy if they open up their wallet and $25 is gone that they thought they had in there. But the question you should ask yourself is, if you opened your wallet and $25 was gone, how disruptive, if at all, would that be to your monthly life existence? Meaning, if you didn't have the $25, would you be unable to pay your rent, a TICO bill, purchase food, and so forth to support yourself during that period of time? So think that through and kind of come up with a number, an imaginary number, where if you were to lose it all, which you wouldn't, but if you were to just lose it and it was gone, again, yes, you'd be sad, but more importantly, find a number where your life would still be able to function and you would still be able to exist if you were to lose that amount. So I just picked $25 as my example. And this is how it works. As the stock market is up near all-time highs, as it is today, then you want to be investing as little as possible in the at-risk side of your investment portfolio. I have here just two simple columns. You have invest in stocks, which is risky, and then invest into savings over here, which is no risk at all. That's just like just putting money into a savings account. As the stock market is at an all-time high, which it's at, a very small percentage of the $25 should be put at risk in the stock market, and most of the money should be going into savings. Should you still be putting money in the stock market even though the stock market's at an all-time high? Yes. Using the dollar cost averaging approach, you should always be investing every single month. But as you'll see as we work through it, depending upon what the stock market does, will dictate what changes you should make in how you invest your money. So in month 2, this is an imaginary number. Let's assume the stock market goes up even higher to a new all-time high. Well, you still take $25 and you invest it, but now you reduce the amount you put at risk to $8 and you increase the amount you put into savings to $17. And that amount will equal $32 in savings, which is $15 from the first month and then $17 from month number 2. Let's make believe that in the third month the stock market goes up even further. It's just on fire. It's not stopping. Everybody's excited and making all kinds of money in the stock market. Well, your job is to again take $25, but now further reduce the amount that you put at risk in the stock market, because the higher the stock market goes, the greater the risk is. The stock market is very much like a rubber band. You know, you can stretch a rubber band and stretch a rubber band and stretch a rubber band, but eventually one of two things is going to happen depending upon the rubber band. Either the tension of the rubber band is going to be so strong that it's going to force your two hands to begin moving toward one another, or if it's a flimsy rubber band, the rubber band's simply going to snap and it's going to be a violent decline or collapse of the market overall. So the higher it goes, especially beyond an all-time high, the riskier the stock market becomes. So you want to reduce the amount you're putting in each month. Then in month 4, it goes up even further. So, you know, once you get down to $5 a month at risk in the stock market, I think you can stay there and say, you know what, yes, it's a risky $5 I'm putting in at the all-time high, but I'll just stick with that and save $20 a month. In month 5, the stock market goes down a little bit. You increase the amount you put into the stock market and decrease the amount you put into savings. As the stock market comes down, and typically stock markets don't go down more than 10 to 20%. 20% is a significant drop. Back in 2008 and 2009, the stock market actually went down over 50%, lost half of its value. But once it starts to drop like it's doing here in my example to 17,000, you once again increase the amount you put into stocks and decrease the amount you put into savings. And as it keeps coming down and down and down, let's say to month 12, where it's at 12,000 now, it's come down from 18,000, the stock market, to 12,000. Now all of a sudden, you'll notice what I'm doing here in months 11 and 12. I'm still investing $25, but I'm taking from my pool of savings that I've accumulated over these previous months, part of that savings, and I'm adding it to the amount of money that I'm putting into the stock market. So it's still $25 a month, but the extra $20 is taken out of savings that I have been saving along the way as part of my investment strategy. Again, as the stock market goes down further, you increase the amount you take from savings. And then once the stock market stabilizes, as it's doing here in months 13, 14, and 15, and starting to go back up, you begin once again, excuse me, to reduce the amount you put into the stock market and begin to build savings again. So conceptually, this is dollar cost averaging. It's investing a certain fixed dollar amount every single month. The percentage or proportion of the money that you put at risk in the stock market should be smallest when the stock market is at an all-time high. And then you increase that amount that you put in, or proportion of your monthly savings that you put in, as the stock market goes down. If you can do that consistently over a long period of time, a couple of interesting things can happen. I'll just take you for a second here to, excuse me, to Google, and we'll look up a compound interest calculator. There we go. We'll just pick this one. So here's a compound interest calculator. Let's say you start out with no money in the bank and you begin to save $25 a month. Well, that's $300 a year. And you give it, let's say, many of you are not going to be retiring for 45 years. And you say, well, what's the average annual rate of return for the stock market over the past 100 years? Well, over the past 100 years, the stock market on average has increased 10.2% per year. Does that mean that next year the stock market's going to be up 10.2%? No. The stock market could be down 30% next year. But over a 30 or 40 year period of time, it's going to move toward the average of 10.2%. So let's say you put in 10% here and you hit calculate. Well, let's see how much money we end up with in 45 years at $25 a month. Well, we end up with $237,000 in 45 years. Now, most of you are not going to be able to save only $25 a month for the next 45 years. A lot of you are going to get your college degrees, you're going to get better jobs, you're going to increase the amount of money that you're able to save. So let's say you actually are only investing $25 a month for the next 5 years. How much will you have at the end of 5 years? Well, only $2,014. So we'll put that up here. We'll just call it $2,000 even. And you get a good job, and now all of a sudden you're able to save $250 a month. $250 a month is $3,000 a year. And a good way to look at how much you should be saving is it should roughly be approximately a 10% of your annual wage. So, if you were making only $25,000 a year, which is not a lot of money by today's standards, theoretically you should be saving about 10% of $25,000 or $2,500. Most of you are going to make much, much more than that. So I'm just using $3,000 as an annual amount as an example here. And now instead of you being able to save for 45 years, you're only able to save for 40 years. Well, let's see how much money you now end up with in 40 years from the future if you save $250 a month, which is $3,000 a year, and you invest it in the stock market. Well, you end up with $1.5 million, as you can see here. Now, some of you might be saying, well, that's crazy. That Professor Gold, he's talking about 10% in the stock market. That's ridiculous. I'm going to use a more conservative number. I'm just going to put in 7%. Well, how much do you end up with? 7%? You still end up with almost $700,000 in 40 years from now. So the lesson learned here is start investing early, start using dollar cost averaging, and use the one primary asset many of you have in the class, which is time. You have a lot of time left to your advantage by investing early, building wealth early, so you have choices in the future.